Okay, hello, welcome everyone. I see there are quite a few people with us already, and I'm sure more will join us as we move on. So we haven't had a Zoom session in a while. I'm really glad that we're here doing this. You guys know I love interacting with our group members. We discuss many very interesting topics, and I think it's very productive and constructive to stay on top of things this way. To have Zoom sessions every month, every 2 months. I'd like to make it actually a monthly thing from now on, but we'll see how it goes. We usually do it every like bi-monthly or something. So let's see here. I see we have again quite a few people in the room. Thank you everyone for muting your mics. If you are done, if we're discussing something and you're done with a question, I'm just going to ask you to mute your microphone just so we don't have any interference or anything like that. So having said all that, I think we can get started with just some general questions and stuff. We have our theme for today is just basically we can discuss anything. So within reason. So whoever wants to start, we can just kind of jump in there and we can take it from there. So who has a question? Who would like to kick things off?
How about hi, this is Chris from Toronto.
Hey,
Uh,
Chris.
just just trying to warm up here, but how about
Okay.
something like gold, silver type that type of thing? Because like you had you correctly positioned well like long time back, right? Like I can't remember when it was, but even last fall we were I think 15% exposed there, and then it really shot up, and then it's kind of consolidated down a bit. Like for me personally, I maybe it's wrong, but I took like some profits on that. But I'm now sort of in that position. Like, should I go back into it like with a higher allocation? Like, I still have a high allocation, but not like as much as your portfolio. I don't know. Do you have any thoughts on that?
Yeah, of course. First, my first thought is that it's never a problem taking profits. So if you make a good profit on something, and I'm sure people who have been in gold and silver for the last year or so, or whatever longer, obviously my position varies in the portfolio, but it's a strategic position. Anyways, there's nothing wrong in taking some profits, especially if we see like really sharp short-term gains. I think it's always a good idea to take some money off the table because we typically get an opportunity to get back in at a lower price point, even if we want to, increase our position back to where it was or something like that. Can I just ask what your allocation percentage is in gold and
It's
silver?
probably like about seven or eight.
I mean, that's reasonable. It's all, the allocation size, it all depends on basically the remaining makeup of your portfolio. Like, if it's increased risk, I mean, I consider the all-weather portfolio, my portfolio now. Um, Typically, it doesn't have as much technology as it does now. So I guess we can
Good.
call it increased risk in that respect. So I think the GSM
Yeah,
sector does a really good job in offsetting some of that
the
risk
techno.
exposure.
Yeah, I
So
guess I guess one of the things I've noticed about you that I really like actually is how like your position in Palantir and Tesla are like a good example, right? Like you really ramped up Tesla somehow at the perfect moment, like you knew when to do it, I guess.
we got that
And
buy signal. It was clear to me that it was the time
yeah,
to buy.
but but that's what I like is you like you got that high conviction, you really like that's to me like the indication of like someone who really is good at investing, that they really ratchet up the exposure when they have the high conviction. And I guess in the way that relates to the like GSM, is GSM to you just like a 15% sort of static position that, or is it also going to be something like that you would ratchet up and down? Because I just get the feeling from like the last year that I've been a member that it's kind of just like a static position. So which is fine, and it's an aggressive like position. Just curious, like if you see it going up and down like the other stuff.
Sure. So it's I would call it more static than uh, like other sectors and holdings. And a lot of that has to do with the thesis that the Fed is going into an easing cycle. So we're gonna see a lot of monetary expansion. We're gonna see much lower rates. We're probably gonna see quantitative easing down the line. I mean, it always leads to that. I know it may not be like a popular um, viewpoint now, but I'm pretty sure it's going to get to that, and rates are probably going to go very low in this cycle because when the Fed starts cutting, usually goes. I think it's going to go to zero. Maybe we'll see the 10-year negative. I mean, it's possible. So it's a really strong upcoming environment for gold and silver. So and also we had like a lost decade. We had like 10 years where basically the price went nowhere because it appreciated so much in the early and mid 2000s that by the time it peaked at in like 2012, it was time for a bear market. And basically since like 2012 to recently, I mean the price it's like the same. Obviously there was a big bear market, but it's still I think we had a period of underperformance, and now we can have a significant period of outperformance. And another thing we should consider is that when gold shot up last time, when the Fed started implementing quantitative easing and everything after the financial crisis, the predominant viewpoint on the street was that this was all temporary, and that the Fed would ultimately reduce its balance sheet to like back to back to zero or whatever. That it would basically unload all the assets that it had on its balance sheet then, and that it would unload them. But that's not realistic. I don't think the Fed will ever unload its balance sheet, so it's just going to be more and more monetary expansion in future cycles. Of course, it can unload some of the assets, but I don't think it's ever gonna unload everything. That just doesn't seem plausible. So that's why I'm so keen on having a sizable allocation in the GSM space, especially now that we're going into this easing cycle.
I see. So probably in the past, you would have had a smaller position in GSM, and just like it's been increased based on just like the background sort of economic situation, you brought it up to the 15 or whatever that is now.
Yeah, I mean, again, it depends on the market conditions,
Right.
because we had that big bear market, and then around the 2015 time when gold was at about, it was at a low of around 1050, and we had Goldman Sachs and all these guys screaming that it was going lower, that gold is dead. So that was like the time. That's when I started like buying more and more and more gold actually, and silver, and that proved to be the right thing to do.
Right.
So uh, again, independent of what the Fed is doing, gold also goes through these bull market and bear market stages, because because of technical factors and different things like that. But I don't think we're near like a high point for gold. I think it can go significantly higher from here. So yeah, I think it's good to have maybe, if like anywhere from 5 to 10, or if you want to get a little more aggressive, 10 to 15% allocated to the sector.
Okay. Cool. Thanks.
Yeah, no problem. Yeah, go ahead. Come on, guys, don't make me start calling on people.
Uh, um, That's a call. Quick question. First of all, can we alternate if we don't want to do an alt, the altcoins?
Yes.
Does it make sense just to have a bigger Bitcoin position?
It does in some respects, and I would also not just focus on Bitcoin, but I would look at Ethereum also because Ethereum is also a very it's it plays a central role in like Bitcoin, it plays a central role in the whole cryptocurrency economy, if you want to call it that. So yeah, I think it's fine if you don't want to because altcoins can be risky, and then of course you have to deal with the cryptocurrency exchanges, so that can be that can be a hassle. So I see no problem with the increased exposure to Bitcoin, Ethereum, or my favorite proxies like GBTC and ETHE from Grayscale. I would be careful with with MSTR MicroStrategy because it's not a it's I know it trades like a proxy for Bitcoin, and I guess it is a proxy for Bitcoin because the company owns so many Bitcoins, 200,000. Uh, but we have to always remember that at at its current level, the company's Bitcoins are priced at over 100,000 per Bitcoin. So it is drastically overvalued. That doesn't mean that, that the premium won't stay there, but we have to be mindful of this fact, and we need to be careful with that particular stock.
Got
Or
it.
the,
And
yeah.
just curious, what was the buy point for Tesla, which made you go so aggressive into that?
What was the buy point for
What
Tesla?
was the signal? What was the buy signal?
The signal was that Elon Musk's pay package was approved by the shareholders, and it became evident that if he wanted, he can get the 25% share in the company that he would like to pursue other very lucrative ventures like increased AI exposure and robotics and all those things that should deliver much more revenues in the future. So basically, it gave him more control over the company, and that was that was kind of the uncertainty that was hanging over the stock, and going into that, and once that uncertainty got relieved, it was a buy signal.
Quick question, sorry to bombard you. Do you ever take consideration taxes when we do selling and buying? Meaning to say is because the end of the year, and we in America especially pay a high percentage on short term gains. Does it ever go into consideration, or the account just makes best decision whatever's for the account without taxes being in consideration?
So I do consider some, of course, the taxes and all the nuances I leave to my accountants. But but I do consider I do consider, of course, the tax implications, and I try not to trade in and out of positions not too much. That's why I guess there's basically limited trading in the account. I view the all-weather portfolio as an intermediate and long-term investment portfolio, not really a portfolio for day or swing trading. I guess if that makes if that clears it up a little bit.
Yeah, and just curious now, a big percentage of the technology positions are in the AI space.
Hmm.
Um, Now, the AI space might be overvalued, might not be overvalued. I have no opinion on that because I've read so much that I myself cannot have. I don't have a clear opinion on it.
Hmm.
Is there any other place which you like besides the AI space, where you think there's a big, let's say if there's a downturn or you want to protect yourself, Is there any, if you might think that AI might, if the market falls 5%, AI may take a 15% dip. Is there any place where you think it should be the market, or where the portfolio should be invested more in?
Do you mean in technology specifically, or in all sectors?
It's a two-way question. Technically, it's a question of technology itself, and then yes, and obviously, which other sectors would you take in order to protect the gains for the year, which we definitely not like to give up.
Right, yeah. So again, I guess the most important thing is to be vigilant of the very high flying stocks in the AI space. So I mean, we try to stay on top of that, like with Nvidia and with you know, Broadcom. I know it's not in the portfolio, but it's one of the stocks that we watch closely. Um, you know, basically all of these really high flying AI stocks that appreciated um, so much recently. Of course, we want to keep a close eye on these, and we want to kind of monitor this sector especially closely, because if things really start to break down, because there's a big difference between you know, healthy pullbacks and then just like the bubble bursts. So we had we've had numerous healthy pullbacks, corrections. Like if you just study any one of these charts, like Nvidia, for instance, we very recently had a textbook 20% correction, and that's like the buy-in area that I was looking for, and it, you know, it kind of nailed it. Same thing happened with you know, with Micron, but Micron, it's not, it's a little different of an AI play. It's not quite as pure. Um, then uh, and then so we definitely need to watch that, like healthy pullbacks and corrections. And I'm sure you noticed that Nvidia, I mean, that's a significant correction, 20%. And but the broader market, it didn't, you know, it declined maybe by a percent or two. So not much at all, because you know, other stocks, sectors, they kind of picked up the slack for Nvidia and the other really high flying stocks. So that's fine. Now, of course, down the line, we could see a more significant correction, and not just in the A stocks, but in the broader market, because the A stocks, they can drag down you know, the tech sector, and not only the tech sector, but you know, if we have like like many of the big companies, not just Nvidia, correcting by 20 or 30%, we're going to see like a 10 to 20% correction in the S&P 500. So how do we avoid the drawdown? We want to not only watch the Nvidias type companies, but we want to watch the other mega techs like Google, Amazon, you know, Apple, Microsoft, whatever. Um, No, I haven't really seen that you know, price action that's too concerning in stocks like Google or you know, or Amazon, for instance. These, in my view, they're still priced relatively cheaply, maybe even, you know, arguably you can say that they're that they're inexpensive here, maybe. So we're not seeing that kind of froth that would, you know, that would suggest we are anywhere like near, you know, where the bubble is gonna pop. Um, Now, as far as like timing a correction, that's challenging. Like if you were to ask me now, you know, when do you think the 5 to 10 correction is gonna come? I would say most likely it could materialize sometime like around mid to late August. Maybe if there are some jitters, you know, like going into September, maybe if there are some jitters about the rate cut. If it doesn't happen in September, we can probably expect like a 5 to 10% pullback then. So likely around like August, September time, we could see that correction. But again, I am, I'm not like a fortune teller. I can't say that for 100%. I'm kind of just based on my, experience and intuition and looking at the market dynamics. If I were to take a guess, I would guess around then. Now, as far as as the tech sector, where I would look at aside from AI, it's challenging to say because AI has become so prominent and it pretty much like permeates like much of the tech sector. So I mean, would I buy like an IBM to be safe? Would I sell Nvidia and like rotate into IBM or something? No, probably not. I mean, because uh, if the prominent AI stocks decline, then the broader tech market would decline if it was a significant decline. So I would probably just uh, just increase my cash position, hedge via like CCDs. I would definitely decrease the riskier holdings, and I would likely rotate to other sectors, possibly materials, oil. Of course, we have GSMs, so industrials, so healthcare. So there are sectors that we can rotate to. I mean, the tech position is very high now in the all-weather portfolio, but I've had instances where it was like 10 or 15%. I mean, you can see this if we go through like the history of the all-weather portfolio in the spreadsheets. Like there were times where it was much smaller. It's high now because that's where the gains have been, for the past like couple of years, and that's where the future gains probably will be in my view. So that's why such heavy exposure in that space.
Can I ask one more question?
Yeah, of course.
Um, any reason we didn't make any adjustments to the ETF portfolio? And the other thing is, if the Fed would be sitting with so much on its balance sheet, was in your mind never reducing it. I mean, there's a time where it will be just too much, and that will just break them. What are your thoughts on that? I mean, there's only so much they can keep on their balance sheet. I
Is
mean,
there?
it's
Is there?
again. So then you're bringing back inflation to it. That's the question. Meaning,
Why?
is it?
No. Why? Why? What
It,
does
it's
what
it's
does
fake
what the
money,
Fed have to
basically.
do?
Let's be honest.
What the Fed have? What the Fed has on its balance sheet have to do with inflation?
It's just not real money. They're just printing money which isn't there, isn't it?
Well, it's there. Yeah, I mean, it's like, I mean, if you want to get technical, it's like a Ponzi scheme.
It's a Ponzi scheme. Every Ponzi scheme has to pop someplace.
Not if there's an authority that's going to pop it.
Some again, some
At some
something will
at some time,
at
yes.
some point
Will it be?
something will happen. Let's be honest.
Okay, yeah. I mean, honestly, of course. But will it be in 5 years? Will it be in 10 years? Will it be in
Got it.
20 years? Look at Japan. I mean, Japan's national debt is it's like it's massive. It's like 300%. It's like over 200% of GDP or something. So it's not exactly like the Fed's balance sheet, of course. It's a little, I mean, we're talking about something a little bit different, but still, the U.S. national debt, it's like about like 130% of GDP or something. But Japan's national debt, it's much higher. Of course, it's an exporter nation, and there's things like that. But I'm bringing this up because um, these things can go on for much longer than you and I think it's like rational or it's possible. So um, yeah, something's going to give at some point, and I believe that there's going to be uh, instances of very high inflation, maybe in several years, maybe in 5 or 10 years. But I mean, we don't make the rules. We have to play by them, and
Right.
And what we can
Make
do
money.
is exactly what we can do is we can, take all the information, process it, and basically and make money with what we can. If you want to boil it down to that, yeah.
And the ETF portfolio, you're leaving the
The
current
ETF
portfolio?
portfolio, I am leaving it for now as it is. The ETF portfolio, it's more of like of a benchmark. It has like some of the best ETFs that exist, and it has it's pretty diversified. So it's mainly I use it mainly as a benchmark um, to kind of measure the all-weather portfolio against, so we can basically see active, an active approach to investing, as opposed to like a passive ETF approach to investing. Now, that's not to say that I don't try to have, I don't want the ETF portfolio to do well, but there's only so much you can do with an ETF portfolio. Let's be honest. And I want everyone to see that. I want people to understand and to see that there's only so much you can do with an ETF portfolio as opposed to like an actively managed, high quality stock and other asset portfolio.
Is the goal still of the portfolio to beat the S&P, let's say?
Yes, of course. The goal
All
is,
right.
is to beat the S&P.
Thank you, Victor. Appreciate your time.
Yep, you're welcome. Okay, so
Victor,
yes.
it's Leon.
Hello, Leon.
Hi. Yeah, new member. I've
Welcome.
noticed a lot of angst. Thank you. I've noticed a lot of angst in the market going on for some months now, and particularly lately about the poor breadth in the market. And now it's become, I think, even the mainstream financial media is aware of it. As far as I can tell, is that something that concerns you at all? Do you totally ignore it? Do you? I mean, I notice you tend to have a lot of the larger stocks anyway in the portfolio. So in that sense, it's not necessarily a concern that it's mainly the mega cap techs that are leading the market. What do you think about that? Because yeah, there is a fair bit of angst.
Yeah, I mean, sure. And there's always some angst in the market, of course, and we can't we should not ignore it. Absolutely not. We should always be aware of these things, and we should keep a close eye on it. Is it something that I base my investment strategy off of, or does it really change my investment thesis? No, it doesn't. But it's like a yellow flag, and there are many, I guess, yellow flags, maybe some orange or even some some red flags that we should always be mindful of and consider. Um, so yeah, I mean, from a perspective, valuations are certainly elevated now. But again, I wanna go back to the fact that really I think the most important thing when it comes to markets, it's really the Federal Reserve, because it comes down to the Fed and the economy. So basically, the Federal Reserve controls the economy. It controls the so-called the boom and bust cycles by by raising and lowering interest rates, and by implementing other forms of monetary tightening or monetary easing. If we look back at and we also need to keep in mind that the market looks ahead. So if we go back to around the time of 2021, like mid 2021, and now then we had an environment when stock valuations were getting very high, when when the economy looked like it was going to to decline a little bit, possibly go into recession down the line. And we also had very low rates, so the Fed was beginning, and we were starting to see high inflation. So the Fed was going into a tightening cycle. That was like a clear signal to, that we needed to get out of the market. That, well, they basically, stocks were likely going to go through a bear market. And I put out an article, not one, but like many articles out then, that there was like a tech crash, an epic crash or something I called it, that it was coming, and we got it. So again, we need to I think we should focus more on what the Federal Reserve is going to do in the near future. We need to focus on the critical economic data, because obviously we want to avoid a recession, because the recession would be bad for the stock market. But if we look now, the economy it's very resilient. Corporate profits are very healthy. Of course, there are pockets of concern, like I said before, yellow and red flags. But still, we have we have a relatively healthy economy going into an easing cycle. So the worsening breadth breadth in the market, it could also be a seasonal thing, because it's summer. There are fewer people participating in the market. Many people are on vacation. So and again, uh, we could see a 5 to 10% correction, or even maybe a little bit more at any time. And this would be, at this point, this would be a healthy development. So, I mean, I think we just need to be realistic about the market, and how it fluctuates and moves, and things of that nature. And we probably shouldn't focus too much on one element or another element, and just try to kind of view the big picture, and maybe have like a longer term outlook, um, and and at the same time keep in mind that in the short term things can always be a little volatile.
Sure. Thank you.
I hope I answered your questions. Sorry if I went a little off base there.
No, that was good.
Thank you. Okay, so who else? Come on, guys, don't be shy. I see a lot of you here. There are over 20 people in here.
So a quick question for you, Victor. So when you're adding SMCI and Sound and Opera, I mean, the very, very high beta stocks, like what your thought process look like? Because you go in and out all the time and do CCDs, and as fellow investors, we won't be able to follow that fast. Do you have any advice for us? And what's your thought process on adding this high beta to AWB?
Yeah, okay. So I mean, these are all different stocks, very different. Like um for instance, Opera, it was like a very very much a momentum stock that someone pointed out to me. It was never really like on my radar. Someone pointed out like how, the trajectory, and it looked very attractive. Then I read some like articles about it from people that some people that I whose viewpoints I respect. And I thought that they made some good points about the company. I also used their browser like a long time ago, so it was, this combination of elements kind of was behind that move. But looking back now, that was, I mean, looking back at like Opera, do I, I didn't ask myself like, do I really need to own this stock? And maybe I didn't dig deep enough into like the ownership structure, because then they came out with that, with that offering, the dilution, and and the stock became really volatile. So that I would put Opera as like a separate story. SMCI is much different because as you probably know, it's one of the leaders in the AI hardware space, and it competes with with its main competitor is, I think it's Dell, with their AI hardware unit, and both have very strong businesses in the enterprise AI segment, which is extremely lucrative. So SMCI, and it's expanding. So it is a very volatile high beta stock, but I think it has prospects. But I still consider it an increased risk investment. That's why I have the CCD on it. And like for instance, if they were to like report guidance that was a little bit disappointing, or God forbid if they missed, their earnings, like even slightly, I mean, this stock would just have like a huge correction. So that's definitely an increased risk risk stock. And sometimes I ask myself, do I need to own this stock? And sometimes I find myself saying probably not. So that's why I have the CCD on a 50% position, and that's why I have considered decreasing and even exiting completely. And I'm still considering that, I may decrease by 50% and leave just the other remaining 50% under CCD hedge. So yeah, and what was the other stock you mentioned? Sorry.
SoundHound.
SoundHound, yeah. SoundHound, it's interesting. See, all these stocks, they have like different stories behind them. SoundHound, it's a very interesting company because it's in the, it's in the sound AI space, and this space has a lot of room for expansion, and like the research that I've done indicates that this space has a lot of room for growth in the future. SoundHound, it's a leading company in this space. So Nvidia has a piece of the company. There are other, big investors in the company. So if these guys like believe in it, and I see that there's significant potential in the segment, and then I also see that they had a good earnings announcement last quarter, good guidance, strong numbers. So I see solid prospects for SoundHound AI. So that's kind of why I own that name. And also, if you notice, I I don't really have like any other or many other like of these small cap companies in the tech space, just because there's so much uncertainty associated with them, that I only go with the ones that I feel relatively certain about. But there's still the increased risk element that we need to consider just because of their relatively small market cap, and you know basically a smaller company, it's always riskier than like a Google or an Amazon or something like that.
Cool. Few more questions if you don't mind. So,
No, that's what
so
I'm here.
when you buy any stock, right? So do you think about your members when you're buying a stock, or do you just buy for your portfolio when you're buying stock? I'll tell you why I'm asking this question, right? For example, SMCI, right? So you have bigger portfolio, like it's amazing that what you did with your portfolio, that's why we are following you, right? But as members who doesn't have that bigger of a portfolio, we wouldn't be able to do CCDs, right? Specifically SMCI, right? If 100 is like 80,000, right? So we wouldn't be able to buy 100 shares of SMCI and write a CCD on it and make $5,000 or $7,000 like what you're doing, right? So that's the reason I'm asking. We are happy to follow you on everything, and I'm just asking your thought process so that we can understand you better. That's the only reason. I'm asking this question.
That's a fair question, and that's a good question. So first, I want to say that I always think about my members, the members of the group. I don't only consider you members or clients, but I consider I have interactions with many of you. Not only here, but in private chat and in our chat rooms. And I feel like like I have relationships with like friendships basically with many of the group members, and I take I take everything that I suggest or that I write about or that I buy very seriously. So obviously I don't want anyone to lose money. I don't want anyone to do poorly in investing. My primary objective is to have basically to make everyone better investors. That's that's what I try to do. And if I can help if I can help you guys become better investors, then I'm doing what I'm supposed to do. Now, having said that, I can't be aware of everyone's individual situation. I can't, obviously, there are some people that have smaller accounts. There are some people that have larger accounts. I know there are people in my group that, obviously have some smaller accounts, and I know some people in my group who have larger accounts than the all-weather portfolio, significantly larger some. Um, so I can't really uh, cater to everyone at the same time, I guess is what I'm trying to say. But I still try to, of course, include different stocks. Like we have SMCI, and I realize that, if you're trying to incorporate CCD strategy with a lot of the names, that some people won't be able to do that. That's understandable. But that's also why I have some stocks like SoundHound AI, because it's there's a much it's much cheaper per share if we're looking at it from that perspective. So people can do CCDs with that stock, and there are many stocks basically that are in that, like, 5 to 10 range, and maybe like $10 to $20 range. So, and speaking of SMCI, I think there's going to be a split eventually. So another reason to own the stock.
Thank you.
I hope I answered your question.
You did.
Hey, Victor, a related question to the last one. If you're not able to do CCD, how should we, and especially if you're not able to track the market very closely, how should we think about like investing from a scores perspective? You have the TT scores. If you look at like 7.5 or over or 8 plus, is the expectation that they will grow by what percentage in the next 1 or 2 years? How should we think about it? Like if you're not doing hedging and CCD and all that.
Okay, good question. So let's do the TT score. So the TT scores, the trade trigger scores, they're a little bit tricky because they factor in different elements, including the risk. So for instance, if you look at the highest TT scores, they're, I believe, in gold and silver. Why? Because they represent the lowest like risk possible. Plus, there is considerable upside potential in the next like 1 or 2 years. So I guess what I'm trying to say with the TT scores, they're not really meant as to be looked at as short-term scores. They're more of like what the stock's capabilities are in the intermediate and especially in the long term. So we're talking like, at least like a year to 2, 3, 4, 5 and years and so on. So like longer term. So because like if we take Tesla now, for instance, it has one of the highest TT scores, but trade trigger scores, but it's gone up. It's gone up so much. Like I did the math, like I did an article, I did the math. It was like it was like 80% since the recent low just in April. So I mean that's quite a lot for a large cap company. Now I'm not going to drop the trade trigger score just because of this appreciation. Why? Because I have a long-term perspective on Tesla, and I believe that, you know, it's at like whatever 240, 250 today, but I believe it's going to be at 500 in like 12 to 24 months. I think that's a very realistic price target for Tesla. So that's why, you know, it has one of the higher scores, and that's pretty much applicable across the board relative to the TT scores. Um, now, regarding CCDs, so uh, I I like to announce the CCDs. Basically, I don't want to. The reason I do them so sparingly is because I don't want to do like for instance a week ago, like several weeks ago, I didn't want to do any CCDs on Tesla because I felt like, you know, the stock had a high probability of moving substantially higher. So it didn't make sense to do like $200 CCDs then, even if like when the stock was 180 or 190, even if I was getting like a 10% premium for them, because I felt that the stock could go much higher. Now that, you know, it's appreciated so much, I see that there's more, that it makes more sense to do some CCDs on Tesla now. So I did some 270 strike price. Um, that's, you know, that makes sense here in my view. Not like I think Tesla is going to have a huge decline, but you know, it had such a huge run up that maybe now it can go through like a bit of a sideways kind of consolidation period. Now, what happens in the sideways consolidation period is that those options, they're going to decay, they're going to decline in value, and probably, or what I'm counting on, is to buy those options back for, you know, if not pennies on the dollar, for like, you know, 50% less or something. So that's kind of my strategy with regarding to the CCDs. I don't necessarily look for, you know, for the strike price to go, you know, I don't really look to hold them through like the expiration period most of the time. Sometimes like I have a very significant position in Palantir here. Like I don't mind if like if you notice I did I did like a 14% position CCD with a $30 strike price. Like I don't mind if those get exercised down the line. I don't care if the stock like goes to 33 or even higher, because I don't mind trimming that position a little bit. That will be like a strategic decrease in the position. You know, I probably wouldn't mind decreasing that position even more. So I may do another 14% CCD on that also. And then if it just goes through the strike price by expiration, that's fine. I don't mind giving those up. But in some cases, I just basically look to rebuy those CCDs at a cheaper price point, and that way we can kind of, you know, increase the performance of our portfolio. Now, also having said that, I don't want everyone, I don't want people putting too much emphasis on the CCDs, because in reality, like once you do the math, you know, they're adding like maybe, I believe last year after I analyzed everything, it was like a 2% increase, like a 2 to 3% increase due to the CCDs. Now that's not bad, of course, but that's not going to break like you know, my yearly performance, because the portfolio returned 47% last year. So without the CCD implementation, it would have been like 44 or 45% return. And the reason for that is because sometimes you know, the stocks they get away from you. Like it just you know, no one's perfect. We can't do the timing thing you know, perfect every time. So sometimes you do the CCD and you intend on buying it back at a lower price, but the stock just, you know, just keeps going higher, and then it just becomes like pointless to, you know, to buy it back. So it gets exercised, but then you kind of leave like a good amount of money on the table. So that's when it kind of goes against you in that way. And that's why um maybe people, just some people have asked me like um like like the CCD strategy, it, you know, without it, like how will I make this kind of performance? And then but then the bottom line is that it's like a double-edged sword. Most of the time, you know, it works out like, you know, in your favor. Sometimes it goes against you. In the end, yes, it increases the returns some, but it's not as much as some people may think. So that's one element that I want to highlight. Now, as far as like what you would like, I guess, do if I do a CCD and then you know, you don't have 100 shares of the stock or whatever. So I mean, there are several options. You just have to, I guess it's like it comes down to a personal preference. You know, you can hold the shares. You can take like a percentage. An option is taking a percentage. You know, just reducing the position by like a similar percentage as I would do like a CCD. Like if I did a 30% CCD on Tesla recently, it's possible to reduce the Tesla position by 30%. There's nothing wrong with that, especially because you know, there's been such a solid profit in such a short time frame. You can either rebuy it at a, you know, at a lower price point, or, you know, worst thing that's going to happen is you're still going to make money with the rest of the position if it goes higher.
Got it. So that's helpful. Thank you. I
Cool.
guess the maybe a one follow-up question to that is, you know, if let's say if I'm not able to do CCD, how do I think about buying? Like if I look at the TT score, buying right now versus dollar cost averaging over several months. So I'm
Mhm.
trying to figure, am I late? Is it already the peak? Or from a 12 to 24 month perspective, it's clear that those are good stocks to invest. But should I dollar cost invest into those stocks, or should I buy all of it if I have a chunk of cash sitting?
Yeah, I mean that's a good question. So uh, I'm actually a fan of I'm a proponent of buying incremental positions. I think it just tends to work out better. So I really don't like chasing stocks or like rushing into stocks just because everyone is buying them. So I guess we want to try to be selective. So what I mean is that we want to have a buy list of stocks that we really want to own, and we want to have like a solid thesis behind it. So also it really helps if you understand what the company does, how it makes money, and how it's going to increase making money, how it's going to make more money in the future. So once you have these factors kind of figured out, you make a buy list of like, you know, of the stocks that you really want to own. Now, I'm not saying like, you know, you want to fall in love with the stocks, you know, but um, really, they're just some companies that we can tell they're going to be doing well in the future. And these are the stocks that we want to buy, but we don't want to just buy them at any price, right? We want to be selective in the price that we pay. We always want to try to get the best possible price. So market conditions, of course, are important. So we understand we're in a bull market now. Trying to time things, it's challenging, but we want to buy things on a pullback. And I often, put out notes like, here's Nvidia. It's it's gone up so much. It's like, maybe overvalued here. Here's a buying level that we could accumulate in. And of course, it's not always gonna hit that buying level. But, if it comes close to it, or if it hits it, or sometimes, it can go below it, then we wanna kind of, you know, then we want to buy. And also a good strategy is to have an initial buy-in range where we would open like a partial position, maybe like 1/4 to 1/2, and then like a secondary or like an optimal buy-in range like below that. For like Nvidia, when when it peaked, I think I said like around around 130, 120 would be like the initial buying range, and then like the optimal, like optimal buying range or whatever, like a more bearish buying range would be lower, like like maybe 115 to even 100 if it goes that low. That would be a massive correction, of course, but it's possible. So we should have like a plan for which stocks we want to own and what buying levels we want to buy in that.
Got it. Thank you.
You're welcome.
Victor, this is a huge election year in politics and all that.
Yes.
What are the kind of impacts you think we should anticipate on the market and specifically the technology sector?
Okay, very good question. So, as far as like, like the long-term image of things, it doesn't matter who wins the election. The technology, technology is gonna prevail. It's gonna move on. It's gonna prosper. I think, regardless. Now, as far as what we can expect pre-election, okay, so let's be realistic here. First, I just wanna say that this is not a political forum. I want to refrain from like, picking Republican, Democrat, like, because that's just going to make people maybe uncomfortable. So so this is again a financial platform. We are here to discuss finance, but we do have an election and we do have politics in the mix. So we need to kind of discuss it a little bit, but we want to be careful on how we discuss it, not to offend anyone. So having said that, we should also be realistic. I'm sure everyone, or maybe people watched, the presidential debate. If people are watching the polls, I believe, the latest polls indicate that Donald Trump is winning, is leading. Whether he's going to win or not, I don't know. How the rest of the debates will go, I also don't know. Joe Biden can show himself much better next time. Um, Anything can happen. But the way things are going now, it appears that maybe Donald Trump could win. So let's try to focus on how the market would react in this scenario. Okay, so I've seen obviously previous cycles and previous market reactions. So I can kind of maybe go by that and a little intuition and just the general market dynamic sentiment. So we can probably have quite a correction, quite a pullback in the markets. Um, and it could happen around election time. Because why? Because it's not because Donald Trump would be bad for the market, but there would definitely be a sense of, I think there would be some kind of sense of panic ahead of like the election or right around the time of the election. I just believe that there would be some kind of event in the market that would cause a significant pullback or correction in the market. We should be mindful of this. Now, the reaction post this pullback correction could be very positive, meaning that the market could rebound swiftly and we could see, like new all-time highs within like a month or so. But I'm saying this because we should anticipate things. That's basically how, that's one of the most important elements to successful investing is being able to anticipate things and position your portfolio accordingly. So, likely there will be volatility. Uh, Probably the volatility will settle down, and very likely the bull market will just continue.
Thank you.
You're welcome.
Victor, I have a few more questions on technicals, if you don't mind.
No, of course, please.
So, whenever I see some of the prices, right? So when you said SMCI, it might hit 700 to 750 and all those rates. How do you come up with these numbers, right? So by any chance, because I got the same number, I use Elliott wave theory for that. So because it's in third wave complete and it has the fourth wave go down. So I'm not sure if you follow EWT or
not.
any other ideas that you have on how can we follow similar technicals.
I do not follow any programs or any theories like EWT or Fibonacci, but that doesn't mean that they don't have merit. The problem that I have with for instance Fibonacci is that if you depending on which time frames you use, the levels they're all over the place. Nonetheless, the popular time frames, they can have Fibonacci retracements like 50% or whatever, 68.1. I've studied those, so I know what they're about. They're applicable in some cases. Now, is it something that I implement on a daily basis? No, I do not. Do they have merit? In some cases, sure they do. Elliott wave, same thing. The waves, I do see the waves sometimes, and sometimes they apply perfectly. Sometimes they do not. Um, so I focus more on I guess you can call them like maybe the traditional technical indicators. I look at support levels. I look at the 50 and the 200-day moving averages. I look at I look at the RSI, the the full stochastic, and the volume, and I guess just the boring things. But the way that that I came up with that 750 SMCI level is just because it's a clear support level on the charts. So if we look at an SMCI chart, we see the 700, 750 support level there. And that's a support level that, and many people see it, not just I. So if it gets breached, then, then stop losses start to get triggered. And then, that kind of creates creates more sell volume, basically.
Thank you.
You're welcome. Okay.
Anything happen, or it's coming out of cash or bonds right now. So what do you do with that environment? You just stick with the winners? Yeah, you can't sidestep it, right? You have to be.
Sorry, does someone have a question? Because I just hear maybe someone unmuted their mic and I can't tell if that's a question or if that's the TV in the background.
We almost do a misnomer calling it IT or calling them growth stocks anymore.
Okay. So, Kathleen, did you have a question? Because I believe that was your no? Okay.
I have a question,
Yes.
and maybe you have already answered it, but regarding the Tesla, great buy call at the right time. And then you did a CCD first of all, and then I think you bought it back the next day because it was going up.
Yes.
Then you did the CCD again for 270, and as of now, even today, Tesla, it's like it initially was down about it went to 245, but then it just jumped back to about 255 right now.
Mhm. I should have bought the CCD back at 245.
Yeah. Well, there are two big events coming up for that particular stocks. Like maybe in a couple of weeks, they're gonna come out with the results for quarter 3, and then 2 weeks later, they're gonna come with the robo taxi event on August 8th.
Uh-huh.
How do you see like those two events affecting the stock price?
Well, that depends on what's going to be announced at those events, and you know how market participants will interpret that information. So I'm sorry, what was the first event that you said?
Quarter 3 results.
Okay, yeah. Q2 results.
Yeah.
Yeah. Yeah, that the Q2 results, those will be out, I believe, on the 23rd, so that's 2 weeks from now. I mean, I just put out an article about it, so I think it's going to be a slight beat on revenues and a slight like a slight beat on the EPS. I think the consensus is 60 for the EPS, and I have my estimate at just 65 cents, so it's not like much higher. Um, will it actually be 65 cents? I don't know, probably not. But I think it's going to be a positive quarter in regards to like slightly better than expected revenue and better EPS, slightly better EPS. There's going to be focus on the guidance, of course. So we'll see, we'll see what the guidance is, if Tesla offers it. Now, regarding the robo-taxi event, so okay, the first one. Now we've had we've had a significant run up in Tesla. So basically, we had a few catalysts for this run up, but now the run up it's extending into earnings. So, it would be, you know, we could have first we could have some short-term profit taking around earnings, and second, it could be like, well, it could be like a sell the news event. I don't expect like a massive sell-off or anything, but I think a 10 to 20 like a 10 to 15% correction in Tesla, like sometime between, probably it will probably occur after earnings, because I don't see the stock selling off by that much before the earnings. So I think we could have a bit of profit taking, but nothing too major. and then, you know, probably more buying into the robo-taxi event. And I'm not exactly sure on what's you know, of course, on how that's going to go, but from the research that I've done, um, I the robo-taxi can be a massive business. So, I mean, it's possible that it's possible that that could also, you know, be another catalyst for the stock to move higher. So, it would, you know, it's also possible to buy back the you know, the CCDs here, or, you know, better when when the stock was at 245. But, you know, I don't like to jump back and forth too much with the, you know, with the CCDs. Plus, I have like a very significant position in Tesla already. So maybe this time I'll just see how, you know, how it goes around earnings. Maybe I'll just keep them through then, because another factor to consider is that once earnings uh, one of the reasons why the premiums are so high now is because of the earnings. So as soon as earnings pass, those premiums are going to drop. Do you see what I'm saying?
Yeah.
So so even if the stock is like at, you know, at 260 then, or whatever, or after it say the stock is at around 250 now, and whatever the CCD premium is, I'm not looking at it now, but maybe it's like $15 or something for the 270.
Right now it's at 1702 as we speak.
Okay, okay, so you're looking at it. 17. Okay. So say around earnings, it's at the same price, like the stock would be at the same price now, but after earnings, that CCD could be at $7. Do you see what I'm saying?
Yeah. So you think you're gonna keep it even though, like, because it has run up, you sold, you
It's
bought
run up
it
a
at
lot.
like 1272, 270 strike price, CCD you bought it around 1272.
Yeah, whatever. I think it was like 1275 or something.
Yeah, yeah, and right now it's almost knocking the $17.
Yep.
Yeah, so
This this is one of the I guess one of the risks with doing the CCDs. Like, it's an excellent strategy, but, you know, it's not going to work perfectly every time. And of course, there are going to be instances when you're going to be tempted to buy back. And again, it's like a personal preference thing, whether you do it or not. So for now I'm monitoring it, and, you know, we'll see how the stock trades going into earnings. Maybe I'll just let it maybe I'll just let it ride, see what happens. But having said that, I am very positive on Tesla going into earnings. And even though I'm expecting, you know, like a 10 to 15% pullback at some point, obviously I'm not going to time it perfectly. And I think the robo-taxi, really the prospects of the robo-taxi business are massive. I think the market underestimates it like a lot.
yeah, thank you. And second question I had was for like the Bitcoin MSTR. I know you talked a little bit about it. It's massively overvalued by over 100%.
Yes, this is true.
Right. So, like, if you want to get into Bitcoin, what would be a good proxy ETF you would recommend?
GBTC,
GBTC,
that is the best.
that is the best one.
That is, it's the biggest by far physically backed ETF, Bitcoin ETFs. I think it's backed, if I'm not mistaken, 600,000 Bitcoins.
Okay.
So it
And
owns,
you are bullish on Bitcoin mid intermediate to long term.
I've been bullish on Bitcoin since 2016.
No, I mean, right now after the
Oh,
pullback, it was over
yes.
70,000
Yes.
and now it pulled back to, I think it took a dip up to 53K.
Yeah, I think my I think I've maintained my bullish viewpoint on Bitcoin with a pullback target range to around, 55,000. So right around here. I think 50K would be exactly a 30% pullback from the peak or very close to it.
And you think that can still happen, even though it dipped to 53, it's right now it's about 56.5.
Sure, it could still hit 50.
It
I
could
think
still hit 50.
I think the probability is maybe less than 50% now, but
Mhm.
not by much. Maybe around 40% or so.
But once they start cutting the interest rate, you think it can
I
hit
think
the
it can
all-time
fly.
high.
Yes, I do think so.
And I mean, there is a Fed meeting at the end of this month, July 30th, 31st. Do you see any probability of a rate cut, like surprise rate cut?
Surprise rate cut. That would be a very low probability. I would put that probability at maybe 5 to 10%. And we would have to have like a really good CPI number this week, and we would have to have probably some worse than expected economic data, some key economic data, and we would also need what date is the Fed meeting? Well,
It's July, end of July, 30, 31st. So
okay.
I think 31st, they will come out with the statement. 31st, it's gonna be the
Perfect.
Wednesday.
Yeah. So I mean that's right around the final inflation reading of the PC, but that's not probably not going to make a difference. But yeah, very low probability.
Yeah, I mean, the Fed is independent, but as someone mentioned, this is an election year. So how many rate cut do you see before election?
Hmm. One or two. At least one.
At least one. You targeting the September meeting, right?
Yep.
And by how much you think it's just gonna be 0.25 or 0.50?
No, I think only 0.25. If 50 is, I don't see a reason for it to be 50. 25, and then yeah, probably one, slight probability of two.
Slight probability. Okay.
Could happen. Again,
Okay.
it depends. It depends on we need to watch the data. Because, all right, if we break it down, the key pieces of data that really influence the Fed's decision and the rate cut probabilities are inflation and jobs. Those are like the key, like the really, really key ones. So CPI, PCE, and the non-farm pay, the non-farm payrolls that come out first, just once a month, every first Friday. Those are the three major ones that we need to watch.
Okay. Thank you.
You're welcome. Okay, guys, we have about 10 more minutes, so we can do a few more questions.
Hey, Victor,
Yes.
what is your take on lithium stocks like LAC and AITM? How long it may take for these stocks to recover, or is it better to sell those and buy something else? Or
Hey, that's a fair question. So, first I wanna say that that these are very different companies. Like, I know that, in some sectors we can kind of mold like several companies into like, almost into like one because they're so similar and their businesses are so similar. But in regards to these lithium stocks, they're actually very different. Like ALTM, it's a combination. It's a new company. It's a newly formed company, but it's actually two companies. It's the American company Livent, and it's the Australian the lithium mining company. The American Livent company, it's the dominant company, the managerial company. It's essentially, it was called like a merger of equals, but it's essentially Livent buying out um, the Australian lithium miner. Now, Livent is a company with an excellent track record, and it's been in business for, I believe, for 80 years almost. Um, so now, what happens with the new company? We have a lithium company now that that doesn't just mine lithium, but it's one of the most diversified lithium compound manufacturers in the world. So you're getting basically the best of two worlds in this company. You're getting excellent mining resources, and you're getting like the decades of expertise and and the excellent infrastructure and worldwide network that Livent offers with its core lithium business. So this really is a special company that I think the market just has no way on how to value it right now, and it's not valuing it like you- it's a newly formed company, so the earnings, you know, it's difficult. It's very difficult to value. It's easy to short, but it's difficult to value. Um, so basically, the market is using this opportunity to press the stock down, and of course, this gets exacerbated because of the general slowdown in the EV segment, the temporary glut in lithium, and and the low lithium prices, which I believe it's also a temporary phenomenon. Um, Now all these factors combined, they make like a perfect shorting environment. So this is why the lithium stocks are doing so poorly recently. Um, are they going to go out of business? I mean, is Livent going to go out of? No, I don't believe it will. This is like typically this is the time when you want to be buying in any sector, not just lithium. When sentiment is horrible, when everyone is selling, when, as they say, when there's blood in the streets, that's when you want to be accumulating. Is it increased risk? Of course it is. Is there like a chance, that these stocks can go lower? Of course it's possible. But having said that, I stay true to my conviction. Um, I believe that the EV slowdown, I am very convinced that it's temporary. There's been a temporary, transitory oversaturation in the market because there just so many EVs came to market simultaneously recently. First it was just Tesla, then it was like a limited amount of EVs from like cheap Chinese BYD and and uh and like a few EVs from Audi and Volkswagen and the established automakers, and then you have like the EVs from Ford and GM, which but uh I think so basically it's just too much. It's just too much at once. So the market became oversaturated. It's fine, it's normal. There's nothing wrong with this dynamic. Again, we need to look past this, and we need to take a long-term perspective. The long-term perspective dictates that um you know, that the trend, it's in the EV favor. It's not in the favor of ICE vehicles. Are ICE vehicles going to disappear tomorrow? Of course not. But gradually, we're going to see EVs taking more and more market share from the traditional ICE vehicles. And then I'll tell you more. Many countries, and especially China. China is the most important auto market in the world by far. There are more drivers. They're in China. It's like twice as much as the U.S. population, just the drivers in China. Or it's probably even more than that by now. So that's the most important market in the world. China has a phase out policy where there will be only EVs, you know, sold for commercial purposes. Like I forget what the time frame is, but it's in like the next 10 years or something. So it's not that far away. And also many European countries are on the same track. And you know, even the US has some, you know, I guess some solid goals on how to, you know, gradually phase out you know, ICE vehicles. So this temporary slowdown in the EV segment shouldn't be, you know, taken so seriously. That's why I'm so bullish on Tesla, and I should probably be more bullish on, you know, stocks like Rivian and maybe NIO, but the, you know, NIO is really in financial trouble, so I'm a little concerned about owning that. So and this all comes back to lithium too, because of course more EVs, more lithium, and the price of lithium, I don't think it can stay this depressed for much longer. So yeah, I'm staying committed to the lithium segment. As far as LAC goes, that's a different story because, you know, that's an increased risk company that, you know, there's no revenues there yet. It's basically a bet on the huge lithium project that they're involved in, that they have exclusive rights to, that they're developing. You know, the Thacker Pass project. There are concerns there, but there are also, I mean, there's also so much potential in that project. Just enormous potential. Will they succeed? I think they will. Will they need more money to succeed than they've already gotten? I believe so. So the LAC, it's a much different trade. It's like a longer term trade, and we need to be mindful of the increased risks there, but there's also enormous potential. So I mean, that stock has the potential to increase by like tenfold within the next 5 years if things go right. That stock can also lose another 50% if there's more dilution. So I mean, it's the risk reward thing that we need to be, you know, mindful of here.
Thank you.
Yeah, sorry it took so long. I hope I answered your question.
Baidu, when is Baidu going to be given up on? I mean, it's a very good stock, a very good position, and we all know that. But sometimes it's the cost. And you know what my thoughts on Match are. The cost opportunities some become huge there.
Yeah, the opportunity cost. I'm not giving up on Baidu. No, not yet.
Match either.
Not yet. I'm not betting up on it. I'm not giving up on it. I'll tell you. I mean, I think I've expressed why. So it's enormously undervalued. The market has completely disregarded it. The undervaluation of it. I think its market cap is like is around 30 billion, but its cash, if we include its cash position, which is massive, and its, you know, in its debt position. I believe its enterprise value is only around 16 billion. 16 billion. This company's enterprise
I agree.
value, 16 billion. I mean, so obviously the market just is completely disregarding the stock, which is another time that we want to be accumulating and not selling. So I'm not giving up on Baidu.
Yeah, but I mean, Match. Do you have the same conviction on Match as on Baidu?
No,
I mean,
I
Baidu,
don't.
I understand
I don't.
very well.
I don't. I don't-
matches.
I don't have the same conviction on Match. I like Match for other reasons. I like Match because I believe that I mean, it is extremely cheap, and I believe that, you know, online dating, it's not going anywhere. It nearly has a monopoly in the online dating segment. You know, it owns some of the most I guess widely used assets in the industry. So I don't see a reason why I would sell Match here. The opportunity cost I understand, but again, we can't be, you know, like pounding the table and expecting the stock to go up when we want. We need to be a little patient, and again, it comes down to a personal preference on how patient you know, you choose to be. Of course, you know, you can decrease or you know, close out your Match position at any time if you own it, or if someone else does. I mean, it's a personal preference, but I think for the prospects and rewards that it offers and represents, and the limited downside risk, I don't, even though it is the opportunity cost factor, it's there, of course. I'll give Match a little more time too. I'll consider, if it stays depressed for another 2 quarters, I'll consider reducing, and possibly, you know, I'll definitely consider reducing them.
Thank you very much.
Thank you, guys. That's our time for today. Thank you, everyone. Excellent questions. Of course, we will do this again. Great to see everyone. I'm recording this, so I will post it for the rest of the group. Thank you, everyone, for participating. Have an excellent day, and have a great weekend. Oh, I'm sorry. Have a great weekend.
Thank you, Victor.
Thank you, guys. Bye.
Thank you.
Thank you. Bye.